In this video, we're going to look at how you can finance buying your next business. I'm going to keep it very, very simple. I'll quickly cover unsecured loans, secured loans, peer-to-peer lending, but then I'll cover my favorite area, which is deferred payments. Watch this video. It really is going to be a game changer in terms of you buying more businesses without any of your money. In this video, I'll be talking about funding and financing a business. Now, just to start off, there's lots of different ways to fund a business. And I'm not going to cover every single one of those because I'll be here for way too long and I'll have to make a lot of videos if I wanted to break every single one down and keep it really simple, really high level, just to kind of raise your awareness. So the first one is, depending on the size of the business you're buying, you could get an unsecured loan, usually up to £25,000, and which is usually tends to be a personal loan. So that might help you with paying the deposit towards buying a business, and then depending on how you structure the rest of the payments, that might get you started and moving. Above and beyond that, your second option is to get a secured loan. Usually you'll need to give a personal guarantee here, and some other form of security as well. Ideally, you want to get this loan where you don't have to give any security and there's no recourse. But of course, that's easier said than done. Most banks, especially in the current climate, don't like it. Can that be done? It can be done, absolutely, but you're going to have a good business case, and you're going to have good experience or good loan coverage, serviceability, and a good team around you to have no recourse or non-recourse loan. You've got peer-to-peer lending. Again, interest rates are higher, but you can get the money quicker. And like I've said, there's other ways of buying businesses as well, but just bear in mind, unsecured loans, secured loans, peer-to-peer lending, which is the real simple ones. And then my favorite one from all is deferred payment. So this is where you agree to buy the business and you're going to make payments over a certain period. So I'll give you an example. I'm just about to complete, in fact, on a deal, buying the business for £175,000. Agreed to pay £125,000 up front, £25,000 after year one, £25,000 after year two. So the £125,000 is coming from a bank. The £25,000 after year one will be paid from the profits of the business. The business makes about 80 to 90 grand profit per year. So even if we don't improve the performance, which we will do, but if we don't, from that we can fund the £125,000 loan, interest and capital repayments over 15 years. Plus we'll have enough money left over at the end of the year to make the first £25,000 repayment. Second year, same again, and after year two we'll have a business making minimum of 80 to 90 grand profit, although it's going to make more than that because we're going to improve it, and no money down from a buyer's perspective. So that's a deferred payment, which works really well. Then you can have an earn out with the existing people staying in that business for a certain period of time, and then you pay them over that period, and you can also pay them to stay in the business, and then they get an earn out. That is also popular, but my preference is to have a deferred payout over a number of years. The one I've just shared with you is over 2 years. Another one I'm doing over 4 years. I've seen people do 5 years, 10 years, 15 years. One person even managed to do 20 years. And I haven't seen many of those. I've only seen one of those. But usually 3 to 5 years is pretty achievable. Now, not every seller will do that. Not every seller is up for that. But you got to remember, it's not easy for them to sell their business. Again, depends on the business itself, the demand, the industry, the economic climate, the funding options, how many people are interested in buying that type of business. But generally speaking, for small businesses, it's not that easy for them to sell. So it's going to be hard work for them, and the longer they've had it on sale, the more keen they are to sell it, because they want to get out. And obviously, depending on their motivation for why they want to sell, usually retirement, or they've had enough, or they're leaving the country, or they've had a death in the family, or one of the other key staff members has left or has passed away, or something else has happened, then the business kind of, or the business owner relied on them and they're not there anymore, so that the business owner doesn't want to go back and start doing more hours or spending more hours in the business. There's a whole host of different reasons why somebody wants to sell a business, but the bottom line is they want to get out. So you want to try and establish what their motivation for selling is. And it's not always just to get all the money in one go up front either, by the way, because if it was, then deferred payments wouldn't work, and we're making them work, and I know loads of other people who are making them work. Once you figure that out, then say, okay, let's now come to an agreement in terms of what you're looking for, and then spread the payments over a certain period, and in the end you don't have to put any of your own money down. The bank or a third party can fund some of it, and the business funds some of it in terms of the initial loan that you get to pay for the upfront amount, plus whatever you've deferred. The profits from the company will enable you to do that. Now, as I've said, there are other ways. I think there's 23 ways in total that I've got that you can buy a business. We don't want to complicate that for you. We don't want to make it difficult, and that's why I've just shared unsecured, secured, peer-to-peer lending, which is kind of real simple stuff, but I've focused on deferred payments because I think that really works exceptionally well, and if you can make that work, you'll be thinking, why don't you buy a business every single week? And the answer is, well, you should, if you can find a deal that works for you, and the business works for you, and the debt serviceability works, and it's a business that you've got either expertise in, or you've got a team of people who have expertise in it. You'd buy one every single week if you could, and grow, because as you grow the business, and let's say you've only got one business, and that's worth 3 times EBITDA, so EBITDA is earnings before interest, tax, depreciation and amortization. If you've only got one, then that's worth 3 times EBITDA. If you've got 5 of those businesses, or 5 stores, or 5 different locations, that could be worth 5 times EBITDA. If you've got 10 of them, for example, they might be worth 8 times EBITDA. If you've got 15 of them, they're worth 15 times EBITDA. And if you've got 20 of them, again, I'm just making up this example, if you've got 20 of them, it could be worth 20 times EBITDA. So if you buy 20 individual ones, you've paid 3 times EBITDA, but because you've created a bigger business now, so more turnover, more profit, and you've improved the business and streamlined it and made it more efficient, because you've got 20, now it's 20 times EBITDA. If you do nothing else, just by collating all of those businesses and making them work, okay, you've got a much larger exit value in itself. By the way, that's not the only benefit to you. You're going to improve the profits, you're going to improve the cash flow, you're going to make money on the journey, but at the end, the 20 times EBITDA is a lot more than what you paid for it. So your quid's in, and if you've done deferred payments, you've got the business to fund the payments, both in terms of any initial loans that you've taken, plus any deferred payments. So it really is a no-brainer if you can make it work. Sometimes people say, oh, this sounds too good to be true. Is it really true? It is true. The hard work really is going in the business and making sure you can sustain the business, making sure you can make it work and keeping it going. But it can't all be just plain sailing. You've got to do some hard work, and if you're up for it, this is a really good option. I think you should seriously consider it. So until the next video, bye for now.